Good morning. It's a much better looking screen this Tuesday morning as the benchmark indices gain close to about 0.5%. The mid caps are up nearly 1%. We've got a positive advance decline ratio. You're watching Trading Hour. I am Reema Tendulkar and with me is Vivek. And Vivek, if you see that intraday chart, it's good to see that about 30 minutes or 45 minutes back, there was a dip in the markets and that was bought into.
That was bought into, and that is the heartening part as far as today's trading session was concerned. When that dip came, there were worries that today could turn out to be another session like yesterday. As you can see in the screen, at 10 a.m. approximately, you did see quite a sharp dip and very, very volatile trading session. In fact, if you talk about what's actually aided the market recovery or the market bounce, largely the Pharma pack, and the Pharma pack continues to do quite well. Look at a couple of names. First one, look at Biocon. This particular stock, there's a Jefferies upgrade that's coming up almost 7% today. Zydus, positive news flow coming in. That particular stock was doing quite well in the session. Apart from that, the oil and gas pack, yesterday, remember, this entire space was beaten down quite significantly. ONGC today is the top Nifty gainer. A couple of days ago, Jefferies upgraded the stock. Today, CLSA calls this particular stock as its high conviction outperform rating. And lastly, on the other hand, in the broader end of markets, Zomato today has fallen. There's a Jefferies downgrade. They are worried about competitive intensity as far as the quick commerce space is concerned. Cut their multiples sharply as far as Blinkit is concerned. And on the back of that, Zomato today, as far as the broader end of the markets, Reema, this particular stock down almost 4.5–5%.
Indeed, we'll talk more about it. It has had a one-way run, and today it's the first time we've got a brokerage, a sell-side analyst coming out and not saying they're cautious because it's still a hold rating, but perhaps just indicating that the upside from here on could be limited. But again, it's not a negative note, but just saying maybe the run-up is done for now. But we'll discuss this in greater detail. For now, let's take stock of the Q3 earnings season, which is upon us. It starts with TCS and Tata Elxsi on Thursday. Prateek Parekh from Nuvama Group is joining in to discuss the market fundamentals. Prateek, morning, and thank you very much for joining in. Now, Q2 was a rough quarter, a tough one. We saw a lot of earnings downgrades. What is the investor positioning and expectations going into Q3 earnings season?
Yeah. Hi, Reema. Thanks for having me over. So I think if you look at Q3 earnings, so far, the feelers that we have got seems to be a very similar to what we had in Q2. Top line recovery, which everybody is expecting, is getting delayed. This is likely to be the 7th straight quarter of sub 10% top line growth. And for profit growth as well, for our coverage, excluding the volatile OMCs, the growth rate is going to be around 9%. So, which is very similar to what you've seen in H1. And clearly, if you look at the consensus earnings estimates for F25 and F26, for H2, they are forecasting mid-teens growth. So from where earnings expectations are built in, I think clearly there is going to be more likely downgrades that are going to come through. But nonetheless, if you look, the investor positioning to some extent is already ready for that. But I think the earnings recovery is proving to be elusive. And that, I think, is a source of concern and I think a key monitorable for the year 2025 itself per se.
So what's the extent of earnings downgrades? What is the Nifty EPS estimate for FY25, FY26? What could it be scaled down to? And in Q3, where might the earnings disappointments come from?
Yeah. So I think if you look at the Nifty earnings for 9-month FY25 based on our preview numbers, we are likely to be around 3–4% range. The full year forecast is around 10–12%. So I think most likely we'll end F25 in single digits. For F26, the earnings forecast is in mid-teens. This is likely to be pruned down, and the way things stands, you will again, in most likely in F26, get a single-digit growth. The simple reason is that the margin tailwinds are no longer there, and demand dynamics is still not very, very conducive for a big growth because credit growth is slowing down, exports are weak, and the policy support that is needed is not there. Once the policy environment turns stimulative, I think we can see a better earnings outlook. But until then, earnings downgrades are quite likely. The downgrades are likely to be more pronounced in commodities. Banks' earnings should hold up, and to some extent in the consumer space, where the recovery is keeping on getting postponed of sorts per se.
Understood that. Pratik, one thing which we want to understand is you've spoken about how H2 is expected to be slightly better. FY26 is expected to be a single-digit earnings growth. Now, going into Q3, how do you see market positioning as far as various sectors are concerned? We'll be starting off with the IT sector earnings soon. So how are you positioned there, and what do you expect? What could be the key upgrades or downgrades coming in as per your assessment?
Yeah. So I think we've been very bullish on the IT space for most of last year, and the call has worked very well for us. Nonetheless, we recently downgraded IT to neutral. This is again a tactical downgrade, and the simple reason is that valuations have really caught up. Valuations in the space have reached the levels that were last seen in 2021 end, and at these valuations, the margin of safety is very low. Small disappointments can lead to big derating. And that's where in IT as well, I think the base case is a stabilization. But nonetheless, small misses on that front, given the way the sector has done well last year, could lead to very wild stock reactions of sorts per se. And we already saw that where despite Accenture's positive guidance upgrade, IT stocks have actually corrected, which tells you that investor positioning is already very heavy on that side, and the room for disappointments is very low per se, Vivek.
IT positioning is high, room for disappointments is very low. Pratik, on banks, now Q3 banking updates came through yesterday. Were they in line with your expectations? Because some attributed one of the reasons for the fall. We were all looking for excuses for yesterday's fall, and they said, well, the banking updates were nothing great, perhaps even worse than what the street was hoping for. So talk to us about what we heard and saw yesterday.
Yeah, I think banking upgrades were broadly in line. I think the yesterday's move is not so much because of the updates, but just the broader dynamics that from here on, the domestic liquidity has become quite tight. And unlike the past 2 years, where India has decoupled from EM, we have had a very good run in equity markets, especially in the cyclical sectors. I think the macro setup is now changing. We are now in 2025 going to be more closely correlated with global events because our domestic liquidity has tightened. And if INR does come under pressure, it does raise dilemma for RBI. Because on one hand, if they defend INR, they drain domestic liquidity, which hurts the overall risk appetite. And that's where I feel that I think the yesterday's correction and 2025 in general will be shaped more by the global events and especially the call on dollar. To that extent, will be very critical in shaping next year's returns. Per se, Rima. It's not got so much to do with updates, because updates I think are broadly in line. And in fact, banks' valuations are also not very lofty. In fact, that's one of the very few spaces where valuations we find are still reasonable. It's just the macro development that is going to be more critical per se.
Pratik, we get that point. So within banks or within financials, where would your preference lie? Is it the private financials, private banks, or will it be the PSU? And within NBFCs, do you like any stocks that you feel, at this point of time can be entered into?
Yeah. So, I won't go in the stocks, but I think within the financial space, we are owing large private banks and also insurance companies. We are neutralish on PSU banks and underweight in NBFCs. And our simple rationale is that typically, if you look at the large private banks and insurance, despite them being cyclical in nature in the past, they have proved to be quite resilient during downturns. In fact, we have highlighted in our report that during the past 3 or 4 credit slowdown cycles that we have seen in post-GFC world, private banks actually have outperformed during downturns. Not only that, their PPOP growth has actually accelerated during downturns. Simply because these franchisees are a lot more quality in nature, and in downturns they are able to price loans and focus on profitability better. So I think private banks do make a case despite growth concerns to be overweight, and valuations over here also are very reasonable, not just relative to market but also on absolute basis. And that's why we feel private banks and insurance are the spaces to be having. PSU banks, clearly the balance sheets have improved and the franchises have become a lot more better in quality. So to that extent, the typical underperformance that you get may not be very large this time, but clearly here as well, credit costs are at the bottom, and small swings in credit costs can weigh very adversely on profitability. So perhaps even over there, a big overweight may not be warranted. And for NBFCs, the whole regulatory tightening, liquidity tightening, and potential rise if any, on the retail stress, I think NBFCs will bear a bigger brunt, and that's a space where we are relatively a lot more cautious per se, Vivek.
So just one quick word from my end. It was a 4% Nifty EPS growth in H1. For H2, what would that number be?
So for H2, I think the consensus forecast was around mid-teens. That number will most likely be brought down, after this quarter's results come through. So far for 9 months, if our preview numbers are met, we should be around 4-5% growth, around 4 to 5% growth for 9-month F25. So clearly, the full year F25 numbers will need to be marked down per se.
Pratik, moving to one particular sector that's done very, very well, especially in the last month or so, it's the healthcare space, the pharma space, and in the last couple of days, even the diagnostic space. Now, as far as the pharma space is concerned, there have been a couple of sell-side analysts who've been calling that maybe this year and first half of next year, you could see a bit of a cliff coming in as far as key generic companies are coming, where a lot of companies, which are enjoying exclusivity, will see patents fall off. So on the back of that, how do you see, markets pricing in the entire healthcare space? Do you still like any names over there, or do you still like any specific pockets of the market there? There has also been a lot of optimism as far as the CDMO market is concerned.
So I think pharma is one space that, again, we have been overweight and it has worked very well. Now here as well, yes, valuations have caught up, and to that extent, the margin of safety is lower. But nonetheless, where we still think pharma, warrants an overweight stance is because while there is, a patent cliff coming in, but also at the same time, these companies, have spent quite well on R&D. Going ahead, you will see companies moving up the value chain and some of the R&D spends done being monetized. So the earning downgrade risk, I think, in pharma is probably one of the lowest amongst the pack. And to that extent, while valuations are high, an overweight or case is still warranted. And that's why we still like the pharma pack as a whole per se, Vivek.
Understood that. So going into this particular earnings season, if you could quickly wrap up, what would be the spaces where you feel there could be beats coming in, and the places where you feel misses could come in, that we could leave it on that note.
Yeah. So I think more than the earnings season, if one looks at the whole year perspective, I think this is the year of capital conservation. We think for this year, that is the key theme. We would rather buy into franchises which are quality in nature and valuations are reasonable. We are overweight private banks. We are overweight telecom and internet because we think the cash flow certainty is quite high. Pharma and cement. And we are quite underweight the whole cyclical pack, where we think, given the demand uncertainties, the downside risks are much higher per se than.
Thank you so much, Pratik, for joining us, giving us your sector review expectations going into Q3. We wish you and the team a very happy 2025. Thanks once again. Well, moving on now, this is our special segment, Quarter Se Quarter Tak, where we bring you earnings expectations from each sector. Today, Rima, who stepped across to the wall, will tell us how Q3 FY25 will be for the IT sector. Over to you, Rima.
Thanks so much for that. So considering the seasonal weakness caused by furloughs in Q3, don't expect too much growth. So we're looking at just about a 1% top line growth for Infy quarter on quarter. For TCS, it will be between 0 to 0.5%. For Wipro, it could even be a negative growth. So the question is, if not the numbers, can the commentary and the guidance support the outlook? There are three companies where growth is likely to be robust. One of them is HCL Tech in the large cap space, so 4% top line growth. And that's because the products business typically does well for HCL in Q3. And in the mid-cap space, it's Persistent and Coforge with about a 4.5% kind of growth. And these are the two outperformers in the mid-cap space with a 70 and 60% return respectively last year. Now on to the full year guidance. Expect Infosys to raise the full year guidance. The current guidance is 3.75 to 4.5%. And most analysts believe that at least the lower end could be raised from the current 3.75% to about 4, maybe 4.2, going up to 4.5%. Margin guidance for Infi, though, is likely to remain unchanged at 20 to 22%. HCL Tech could raise the lower end of its revenue guidance. So the current guidance is 3.5 to 5%, and many on the street believe that this guidance could be raised to 4 to 5%. Or 4.5 to 5%. So some tightening seen, at least in terms of the top line guidance. Our margin guidance for HCL Tech is likely to remain unchanged at 18 to 19%. For Wipro, the Q4 guidance is seen at minus 0.5 to 1.5%. So what will the street watch out for? One, recovery in discretionary spends, recovery in stressed sectors like telecom, manufacturing, particularly auto in Europe, which has been subdued, pickup in hiring. Is generative AI turning out to be a growth driver? How are client budgets as we enter into this year? And deal wins, which have been muted. Now, Nifty IT has given you a 20% plus return for the last 2 consecutive years. And last year, the Nifty IT index was up 22%, outperforming the Nifty by nearly 13%. And stocks started rallying in the second half of the year as growth showed signs of bottoming out and many managements turned constructive. But stocks rallied despite there being a cut in the EPS estimates. Just take a look. We had a double-digit cut in EPS estimates for LTI, Mindtree and Tech Mahindra, even for Wipro, where the stock gave you a return of 25-30%, but EPS was cut by nearly 3%, and the valuations for Wipro got re-rated from 20 times to 24.5 times, which is why recently CLSA downgraded Wipro and Citi introduced a 90-day negative watch list. So as we enter into calendar year 2025 and the Q3 earnings season, it's important to note that the starting point for IT is very different. Stocks have outperformed and valuations are richer, which is what Morgan Stanley says. They say, unlike the start of 2024, when the sector positioning was light, investors are now overweight IT. IT outperformance from here on would require positive revenue and earnings revision, which appeared unlikely in the current macro environment. They stay selective with a view to book profits if stocks show outperformance in the current quarter. Their order of preference is LTI, Mindtree, Infosys, TCS in the large cap space, and Coforge in the mid caps. Jefferies, on the other hand, says that improving growth outlook will support the premium valuations of IT. Yes, Nifty IT is trading above its 5-year average multiple, both in absolute and in relative terms. Valuations are rich, but in an improving growth outlook for the sector, coupled with earnings cuts seen in the other sectors, like domestic sectors, it will support the premium valuations of IT at current levels. So their preferred stocks are ones where you have strong growth visibility. They're going with Infi, TCS, LTI, Mindtree in the large cap space. Coforge, Sagility and Emphasis are their key mid-cap ideas. Back to you.
Thanks so much for that, Reema. Very well and neatly summarized as far as what to expect as far as the entire IT earnings is concerned. We'll now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Welcome back to Trading Hour. We are now shifting focus to the commodity space. Manisha joins in, and today we are focusing on natural gas.
Well, yes, we are doing that because the natural gas prices have just about continued to run up. We are trading at multi-year highs in any case, and the prices did gain by nearly 52% in the previous year. If you look at month on month, the prices are up by 16%. If you look at the overnight gains, it has been a 10% of a jump up that the natural gas prices have put up. Well, one, the commodity has been gaining because there are lower inventories at this time of the year. And the second is, it really is about extreme cold forecast that has been coming in from US, Canada and much of the Western world there. There also are reports that US could be looking at a coldest January since the year 2011. So the demand for crude and its products is expected to be on the higher side. Also, the freeze-offs have caused gas output in the lower 48 states in US to actually almost halt production. That is another thing that seems to be worrying the market. The US inventories also have declined by 1.9%, and they are trading below last year's average at this point in time. So everywhere that you look, it's about lower production, lower inventories, very strong demand expectations for the month of January. And then add to that the fact that there's a lot of rise in gas flow to the US LNG plants, which will then be exported to the rest of the world. So that demand also seems strong. The domestic demand is also on the higher side, with expectations that you could be looking at much higher natural gas prices for most of January and some part of Feb as well.
Thank you very much for that. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar will join in next. Welcome back. InfoEdge is down 4.5%. Now, yesterday, the company gave their Q3 business update, and here are the numbers. Now, Q3 standalone billings have seen a growth of 13%. Now, for InfoEdge, you typically look at billings rather than revenues because the billings will eventually translate into revenues 1 or 2 quarters. So the most accurate estimate of the demand in the current quarter would be billings, and Q3 billings went up by 16%. On a month-on-month basis, it was up 2.7%, and for 9 months, it's up 13.7%. Now, here it's important to note that billings are steadily improving for InfoEdge. They went through 5-6 quarters of low billing growth on account of muted IT hiring. But now steadily, as the management was telling us, that you are seeing a pickup in IT hiring, and it's come into the double-digit category. So 16% growth in the current quarter was 11% in Q2, 14% in Q2, 11% in Q1. So there's been a steady improvement. That's a positive. Now, when you break up their billings into the 2 key segments, one is Naukri, that's predominantly IT, but they do have banking, GCCs, etc. as well, and 99 acres. And you can see that Q3 billing is better than what we've seen in the 9 months, which means there has been a recovery. Now, the stock is down under pressure. According to me, the business update is fine. Perhaps it's just that it's seen a run-up of 60% in the last 1 year, and that could explain why it's under pressure today. And IT is also weak.
IT is also weak today. Thank you so much, Reema, and also taking us through the operational highlights as far as InfoEdge or Naukri is concerned. But it's a good time to get a quick technical check on the market. Mitesh Thakkar joins us. And Mitesh, thank you so much for joining us. What are you making of the markets at the current juncture? Very volatile trading session, but there's been a bit of a bounce post 10 a.m. Mitesh, I think you're on mute. Yeah.
This bounce back looks like a reaction to yesterday's decline. And my sense is that I think, we might see the Bank Nifty try and test 50,500, 600 zones. Similarly, on the Nifty per se, the level to watch on the upside is about closer to 23,900, 950 zones. So I think we might test those levels, but the structure will only improve if we start closing above them. So for the time being, we're trading with a very, short-term bias with some long positions. But if we see the markets decline and start trading below today's low, then I think we'll even want to explore some aggressive shorting opportunities with the fact that we have some bear spreads on the Bank Nifty, which means that we have some bearish positions already open on the Bank Nifty. On the stock side, for the time being, I have a buy on Granules with a stop at 608 for targets of 635. To begin with, maybe we'll look at eventually higher levels. And HAL is a buy as well. Keep a stop at about 4140 or 4135 and look for a target of around 4270, 4280.
Thank you very much for that. It's time to get into a break. Before that, let's introduce the Growth Code, a special initiative by Grow and CNBC-TV18 to further empower retail investors and traders. Renowned investors and professional traders convened at Grow's Trading Right event on the 9th of November, where they shared valuable strategies. Here's a snippet of what pro trader Rakesh Pujara, managing partner, Compounding Wealth Advisors, had to share about the reality of trading scams in the market.
अभी जो स्कैम हो रहे हैं वो क्या प्रकार के हो रहे हैं कि लाइक सपोज आई एम एन पॉपुलर फिगर इन सोशल मीडिया सो my parody account will be formed and people will be invited to join some course or transfer some amount so that they can trade. Even false demat statement have been shown under the name of some well-known international company. Your holding is shown there, actually your holding is not there. You are being promised कि जो सर्किट होगा, जहाँ पर सर्किट है जो स्टॉक्स में, वो ये प्लेटफॉर्म पे नहीं मिलेगा, लेकिन हमारे प्लेटफॉर्म पे आप डालोगे तो आपको शेयर्स मिल जाएंगे. एंड एक्चुअली दे हैव शोन कि वो शेयर्स मिले हैं, डिमेट अकाउंट में उनको दिखाया है, एंड अल्टीमेटली इट टर्न आउट टू एवरीथिंग वाज काइंड ऑफ डॉक्टर्ड. तो ऐसे स्कैम काफ़ी हो रहे हैं. जो काफ़ी पॉपुलर लोग हैं उनके नाम का प्लगराइज अकाउंट बना के कोर्सेज बेचना या फॉल्स प्रॉमिसेस करना.
Welcome back to Trading Hour. Well, one particular sector that's doing quite well is the pharma pack, and within the pharma pack, Zydus Life has one stock that's surging in trade. There's quite a bit of news flow around that particular stock. Winnie joins in with more details on Zydus.
Good morning. So yes, Zydus surely is a stock that's buzzing away in trade today. Now, US FDA, a couple of news flows like you mentioned. So first one is the US FDA has accepted the filing and priority review of Sentinel's new drug application, which is for the drug CUTX-101. Now, this drug is used for the treatment of Menkes disease, which is a very rare pediatric disease that is there. So not many drugs are there or many solutions are there to solve this problem right now. Now, US FDA has granted a 6-month priority review. So on a priority basis, they will be reviewing this drug for Zydus. And obviously, it's an important one coming in for the company because CUTX-101 is granted a breakthrough therapy, fast track, as well as rare pediatric disease, an important one for Zydus. Other than that, in terms of another news flow that has come in because they've signed an announcement and agreement with CVS Caremark, I beg your pardon, and this is to add a couple of type 2 diabetes drug treatments which will be there and added to their template formulary. So keep an eye out on that one because the market size of this overall in the US, according to the data that is coming from IQVIA as on August 2023, was almost around $10 billion. Obviously, there are other companies also in competition, but still for Zydus Life, it becomes an important one. And this will help Zydus expand its reach in the US market, the diabetes market as well, and give a critical growth area for the company. So this will strengthen their position over there. It's an important one to watch out for, and that's why Zydus is buzzing in trade on the back of these two news flows.
Thank you very much for that. And let's get to ONGC, big mover in the large cap space on the back of a CLSA note. Hormis is here with the details.
Well, CLSA's high conviction seems to be paying off right now because that is what it has done to ONGC. It has upgraded the stock to a high conviction outperform, a 360 rupee price target, which implies an upside of almost 40% from yesterday's closing levels. Now, what they say is that the eastern offshore, once it ramps up to peak production, that will lift the domestic output of oil and gas for ONGC by between 10 to 20% by the end of the year. And they are also saying that the removal of the windfall tax will also enable ONGC to earn higher realizations, provided that the crude oil prices globally continue to recover, which they are currently. And despite multiple factors going in their favor, ONGC is still trading at a substantial discount to not only its own historical valuation, but also the historical valuations of its peers. And along with that, it is also offering a very attractive dividend yield of 6%. So as a result of all of these factors, CLSA has upgraded ONGC to a high conviction outperform, the stock among the top gainers on the Nifty today.
But Hormaz, you've also been looking at one of the top drags today, that is Zomato, a downgrade coming in there. What is Jeffrey saying?
It's not a very good day for Zomato as of now because Jefferies has downgraded the stock after the run-up that it saw in 2024. It's downgraded it to a hold from its earlier rating of buy. The price target has also been cut to 275 from 335 rupees earlier. And it is the same quick commerce where they saw a lot of opportunity and they continue to do so. But now that has become an area of concern for Jefferies, where they say that this rising competition is now a worry for them and they're expecting 2025 to be a year of consolidation for Zomato shares after the run-up that they saw in 2024. Now, along with that, they have also cut Blinkit's EBITDA forecast sharply over FY26 and 27 and have halved their target multiple to just 6 times. Now, for Zomato as a whole, Jefferies has cut the EBITDA estimate for FY26 and 27 by 12 and 15%. The profit estimate has been cut by 17 and 18%, and the EPS estimate has been cut by 20 and 21% over this 2-year period. So, downgrade coming in there for Zomato, and it's reflecting on the stock price as well.
Thank you very much for that. Now moving on to the oil and gas space, IGL, GAIL, all in focus today. Nimesh is here to tell us why.
Well, Rima, the reason all the stocks are in focus because BPCL last night has approved, has given an in-principle approval for the IPO of Maharashtra natural gas. It's a joint venture between IGL, that owns 50%, BPCL owns 22.5%, GAIL owns 22.5%, and the remaining 5% is held by the Maharashtra state government. Now, Citi believes that this IPO could be a value unlocking for IGL and MGL. For IGL, they're estimating that this can contribute close to 45 rupees per share to their SOTP valuation of close to 450 rupees. So it's around 10% of what this IPO can add to IGL. As far as GAIL is concerned, Citi has estimated that this could add close to 12 rupees per share in terms of value to their target price of 280 rupees per share. So that's the reason why these stocks are in focus. It's a value unlocking opportunity for IGL, for GAIL, as well as for BPCL as well. So last night there was an in-principle approval for this IPO, and the media reports are suggesting that they're looking at a valuation of close to 1,000 crores to start with. So that's the fresh news, and hence all the stocks, IGL, GAIL, and BPCL, are in focus today.
Thank you so much, Nimesh, for joining us and giving us a sense of a likely IPO from the oil and gas PSU side. Time now for a short break. We'll get you on the markets on the other side.
Welcome back. Blue Star is down close to about 3%, and this is on the back of a Jefferies downgrade. They've downgraded the stock to a hold from a buy, and they're saying the stock has seen a run-up of 140% in calendar year 2024, and therefore, after this kind of a run-up, the upside is limited. The stock is trading at 60 times forward multiple compared to its 5-year average PE of 41 times. So excessive stock run-up, rich valuations, and that's the reason for the Blue Star downgrade. That's Blue Star for you. That's down close to about 3%. The other one that we're looking at is India Marts, and here there is an upgrade which is coming through on India Marts, where JM Financial has upgraded India Mart to a buy from a sell. The target price stands at 2,440. The reason is the stock has seen a significant derating. The stock is down 16% in the last 6 months, 18% in the last 1 year. If you look at the current market price of 2260, it's much lower than the 52-week price of 3,200, and its all-time high level was close to about 5,000. So the stock is derated on account of a sharp deceleration in collections. Basically, the entire MSME space was under pressure. There was no growth. Collections had weakened to a paltry 5%, and there were muted paying supplier additions. So now JM says that it's not that you can expect a quick turnaround, but over the medium term, things will improve. And after the kind of derating that we've seen in the stock, valuations, according to them, are also fairly favorable.
Thank you so much, Rima, for that. India Mart on the back of that is up over 4% this session today. Well, moving on, the Ministry of Statistics, or MOSPI, will announce the first advanced estimate of GDP for the current year at 4 p.m. today. The next year's budget numbers will be based on this data. Lata has done a poll of economists on what to expect from the MOSPI regarding this year's GDP estimates.
Well, first up, we need to know that this is the first step of the budget. What the MOSPI announces, the Ministry of Statistics and Program Implementation announces today at 4 p.m. They're going to announce the first advance estimate of GDP of the current year. Until now, they were only announced the actual GDP up until the second quarter. Now, this is an advance estimate. Now, the point is, they give you not only a real GDP growth, but also the nominal GDP growth. That is the growth in output at current prices. Based on that, the budget, that is the Finance Ministry, will estimate the next year's GDP. And from that, they will estimate the tax to GDP and hence the tax growth, the fiscal deficit to GDP, and hence how much expenditure they can design. So this number becomes important because on this base, next year's GDP is calculated. So what does our poll say? Our poll says that the real GDP in the current year will be 6.3%, a shade lower than the 6.4% we got when we did the poll end of 2024. But it's still lower than the Reserve Bank's number of 6.6%. So 6.3 is a bit of a disappointment if it comes that way. But the more important number, like I told you, is the nominal GDP number. There, the poll said it will come up at 9.9%, which means the actual GDP in trillions of rupees is going to be 324.5 lakh crore or 324.5 trillion rupees. Contrast this with what the budget assumed in Feb 1st, 2024 when the budget was presented. It had assumed a 10.5% growth in the nominal GDP to 326.3 lakh crore. So actually the real number may be a little short, which means 4.9% of that number, 326 lakh crore, was the fiscal deficit, which was about 16.1 lakh crore. Now that the nominal GDP is likely to be smaller, if that's what the MOSPI says, 324.5 lakh crore, then actually even this year's fiscal deficit will have to be lowered to 15.9 lakh crore. And on the basis of that 324.5 lakh crore, next year's GDP will be estimated by the budget on Feb 1st. But let's see what the MOSPI says. It will be very closely watched because after that 5.4% second quarter GDP growth, there was a bit of a shudder in the Indian economy enthusiasts. So we will have to see how much the MOSPI assumes by way of recovery in the second half.
Thank you so much, ma'am, for that. All eyes on that data that will come post-market hours today. Time now for a short break. We'll get you more on the markets on the other side.
Welcome back. SH Kelkar is a stock which is under severe pressure. It's down close to about 5.5%. While the management in the Q3 business update has talked about double-digit growth, but they're acknowledging the margin pressures, gross margins coming under pressure, and that's weighing on the stock today. As a sector per se, it's IT which is on the back foot. The Nifty IT index, led by all the large caps, is down close to about 0.2%. But look at the way the large caps are selling off. TCS is down 2%, Tech Mahindra down 1%, HCL Tech also down nearly 1%. So IT is on the back foot. The NCLT has approved the Indiabulls Real Estate and the Embassy merger. This is something that the street was awaiting, and it's finally come through.
Finally come through. So Indiabulls Real Estate now trades under the name of Equinox, and that particular stock, Indiabulls Real Estate, is locked in the upper circuit of 20%. The NCLT approval for Indiabulls Real Estate and Embassy, remember this is not the listed Embassy REIT, this is rather the residential or the residential operations of Embassy, which will now be merged with the Indiabulls group. So overall, Equinox India is the stock that we're discussing. The stock is up 20%. But moving on, AkzoNobel is in focus after the board was directed to evaluate acquisition offers. Mangalam is here for more details.
That's correct. So the international promoter of AkzoNobel has finally put pen to paper when it comes to the structure of the business in India so far, and they've directed two things to the board. One is to separate the industrial business, which is powder coatings and industrial R&D ops, to a separate indirect subsidiary of AkzoNobel NV, which is the foreign promoter of the company. So the resultant business in AkzoNobel India would be that of only the decorative business. To that, they have asked the board to look for potential acquisition of the decorative paints business, for which they are directed to evaluate and examine any such potential transactions that may come by in the near future, essentially telling the board that the business is ripe for sale, the decorative business right now, and they will be evaluating offers. So the street will keep an eye out on that. While this is happening, we also need to look at who the potential acquirers could be. Here on CNBC-TV18, we spoke with Asian Paints, who did say that they would be up, interested if this business was up for sale. The second part was we spoke to Birla Opus, the second, largest player right now in terms of capacity and the recent entrant as well. They've ruled out any acquisition at this point in time, and only organic growth is that they will go for. And Berger Paints, the second largest player in terms of revenue, has said that any acquisition will be done only at the right price, and they will not enter any sort of bidding war. But it's an exciting space to be in right now, the painting space, because we have one disruptor, a lot of incumbents, and someone who's looking to sell their business.
Thank you very much for that. Biocon is another big mover today. There is a bullish note by Jefferies. Vinny's here to give us the details. Vinny.
Yes, so we have a bullish note coming in from Jefferies on Biocon. They've upgraded the stock to a hold from a previous underperform rating, increased the target price to rupees 400 per share from previous target price of 280 rupees per share. Now, what are the key factors? One, there are a lot of positive news flows that have come in for Biocon in the recent time. Do not forget, in terms of the clearance coming in for its biologics facility in Bangalore by the US FDA in the recent time, that was a key trigger. Other than that, the approval coming in for the biosimilar Stelara, that is slated to be launched in Feb 2025. A lot of approvals on that front from across the globe, and growth visibility of biologics business has started increasing and improving. So these are the key factors. Now, in this also, they are highlighting in 2025 key events that we should be watching out for from Biocon. One, in terms of US FDA approval coming in for the Malaysia plant, that's an important one for the company. Other than that, approval of the biosimilar Aspart and market share ramp up in certain drugs, biosimilars of the company, that is Stelara as well as Aspart, and some generics in terms of semaglutide are key factors to watch out for. Other than that, we also had a news flow that came in this morning where the company had announced the approval of Ustekinumab, which is a biosimilar for Stelara by the company. That has also gotten an approval from Japan's medical agency. So that is an important one coming in there and an important one to watch out for. Great.
Thank you so much, Vinny, for joining us and taking us through the details of that upgrade on Biocon coming in from Jefferies. Well, moving on, the government has launched the second round of productive incentive scheme for the steel sector. Speaking to CNBC-TV18, the steel secretary said the outlay of 4,400 crores is a carry forward of the savings from the first tranche of 6,400 crores. He added that investments and capacity thresholds have been reduced by 50%.
So we rolled out the first PLI for specialty steel, and we had substantial savings in the scheme outlay. So within the same scheme, we have invited applications for a second round. We have named it PLI 1.1. The idea is to make the scheme more flexible, more investor friendly, and focus on areas where there is more need of specialty steel.
Now, speaking to you about the safeguard duty, which has been a long-standing demand of the industry, the matter is with the DGTR right now. What is the expectation? What is the current status of the probe?
So, as far as the safeguard duty is concerned, you know that it is a quasi-judicial kind of a process which the DGTR has to take. They have invited responses, and the last date is 22nd of January. So the DGTR will give its recommendation after that, and then the government will take a call on the safeguard duty. But having said that, it is a fact that we need about $120 billion of investments if we want to remain self-reliant in the steel sector, to cater to the domestic demand itself.
My final question would be about the disinvestment in NMDC. What is the status of that? We were hearing that the proposal is now in very advanced stages.
NMDC, there is no disinvestment.
Right. In the steel sector.
You are saying in the NSL?
Yes.
Yeah, so there is a decision of NSL, I think in 21 the decision was taken. As far as the steel industry is steel ministry is concerned, there is no fresh development on that side.